Hello Mavericks. In our Q&A session covering Module 5, we discussed the homework problems out of Chapter 10, and one of those problems involved a calculation of depreciation. We have two ways of calculating depreciation: straight line and the makers or modified accelerated cost recovery schedule. Now, straight line depreciation isn't used very much in practice. We almost always in the real world use the makers because that's what's required by the Internal Revenue Service. However, the capital budgeting problems that we do in Chapter 10 can be a little bit complex and time consuming. So to simplify things a little bit, some of those problems we use the straight line depreciation method. Now in the straight line depreciation world, again this is not used very much in practice, there's two camps of thought. One is that you should deduct the after-tax salvage value when calculating the annual depreciation charge. Then the other camp says no, not to do that. Now, in the text that we use, the financial learning resource, we do the method where we deduct the salvage value. And the reason we do that is because the external sources that we use, the third-party URLs, the Investopedia that we provide in the financial learning resource for more in-depth readings, in their calculations, that's what they use. Now, me personally, I'm in the camp that thinks that you should not deduct the salvage value, and I've always taught the class this way. And during our session on Module 5, during our Q&A session, I mistakenly did not deduct the salvage value. Not that it's wrong, it's just inconsistent with what we're doing in the text. And I apologize right now because I know that probably caused a lot of confusion and a lot of going back and forth. Like, why is this recording? I'm following the recording that Professor Adams made and I'm getting the wrong answer. That's my fault. I apologize for that. Just a little bit of inconsistency there. However, I will say this, if anything, look at the silver lining on this, is that in business there are a lot of calculations that are subjective in nature. So back in Chapter 3 when we were looking at financial statement analysis and we were looking at those ratios, a lot of those ratios from industry to industry, from practitioner to practitioner, even from firm to firm, may be calculated a little bit differently. So we need to always be certain when we're looking at calculations or analysis that we understand exactly how that's being taken care of. So this is just another one of those examples where reasonable people can disagree on how to do it, and there's more than one way to do it. But for the purposes of this class, when we do straight line depreciation, we're going by what the textbook says, and that is we deduct the salvage value. Alright, so having said that, I want to go back through questions 1 through 5 on that Chapter 10 homework problem mastery to make sure that we've cleared up any ambiguity, any confusion that unfortunately I caused. So let's go ahead and get started on that. So in Chapter 10 we had this big problem with aero motorcycles. There's I think 5 questions on that, and it's a pretty complex capital budgeting problem. And in the first question we're asked to calculate what's the operating cash flow at time 1. In the second question we are asked to calculate the operating cash flow for period 2. The third question, we want to calculate the after-tax salvage value. The fourth question, we want to calculate what's that terminal year cash flow. So what's the total cash flow at the last year of the project? In this case that's year 10. And then finally in question 5, we're going to calculate the net present value. And all these problems have a common set of numbers, with the exception when we get to question 5, somewhere here we go, everyone is going to get a different number for the market value of the land. In fact, each attempt that you do, you'll get a different market value for the price of this land. So, but in all the previous questions 1 through 4, which do not use the market value of land, it's set at $2.6 million, and that's what I'm going to use in this example.